Welcome to the Cash Rich Exit podcast. I'm Colleen O'Connell-Campbell, wealth advisor at RBC Dominion Securities and your host. If you're a founder, CEO, business owner, this is your roadmap to exiting, not just successfully, but cash rich. Today, I'm joined by Jean-Pierre Laporte, a seasoned pension lawyer and the mastermind behind the personal pension plan. We're not diving into legal jargon and actuarial tables today. Instead, we're sharing real-life stories, a series of short, powerful case studies showing how individual pension plans, IPPs, quietly but dramatically improve the wealth trajectories of incorporated business owners across Canada. These are stories of transformation, tax burdens being turned into wealth engines. Whether you're scaling fast or nearing your exit, these examples might just reshape how you think about building personal wealth inside your corporation. And hey, if we haven't met and you haven't booked your one-on-one wealth gap analysis with me, now's the time. Let's uncover the gaps standing between you, your business today, and your cash-rich exit tomorrow. JP, it's great to have you here on the Cash Rich Exit podcast. And let's just get diving in with your background. Why do you find yourself in the chair of a champion for individual pension plans, or as you've created the personal pension plan?
Yeah, and let's before we get into any further distinction, let's just call them registered pension plans.
Sure, let's do that. Registered pension plans.
Yeah, so I love registered pension plans because I'm a pension lawyer. That's my background. I was called to the bar in 2001, so that's 20 some years ago. And my whole career has been spent helping Canadians save for retirement using registered pension plans. The pension plans that I used to work with were multi-billion-dollar pension plans, some of the brand names that everyone's familiar with. But over time, I realized that in the small private sector, where a lot of your clients are operating, nobody's offering them a true registered pension plan. Instead, they're going to be offered an RSP, a tax-free savings account, maybe a whole life policy, maybe to save money through their corporation. But nobody's saying, hey, you should really set up a registered pension plan if you want to save for your retirement. And so about 14 years ago, after having done extensive research in this industry, I realized that it was time for the small business owners in the private sector, and we're talking about over 1.5 million people, given access to true gold-plated registered pension plans. So that it's not just civil servants and teachers and unionized workers in large companies that enjoy these. Now your clients can enjoy the same quality of pension. And I decided that this was time to start bringing that quality of product to the industry.
And so you founded your own firm to focus purely on how to elevate the knowledge here and get more of these
Exactly.
enacted, essentially.
Exactly, because there are no champions. There are no champions for registered pension plans in the small private sector.
And they're not new because,
No.
I've been in this industry for 24 years, and I remember investigating them along this pathway 23 years ago, we'll say, maybe not in my first year or so in wealth management, but there were a lot of hurdles that had to be met, and some of them were just a little too onerous, but there's been a lot of changes. Maybe before we get into talking about some really interesting scenarios, stories about business owners who you've worked with over the years, maybe it would be helpful to have just a quick background on where we were versus where we are now with the type of registered pension plan that would be suitable to an incorporated business owner or incorporated professional.
Yeah, so these registered pension plans typically are governed by two levels of government. There's the CRA, the federal government that regulates the tax aspects. And then depending on the province in which you're located, there would be also provincial pension legislation that might also apply.
And let's focus on Ontario.
We will. So in Ontario, until December the 8th, 2020, so from when you started looking at them 23 years ago until December the 8th, 2020, an individual pension plan or even a personal pension plan, a registered pension plan for a business owner had to be registered both with CRA and with, in those days, it was called FSCO, the Financial Services Commission of Ontario, now called FSRA, Financial Services Regulatory Authority, the provincial pension regulator. So you need a dual registration, which brought with it complexity and costs and a lot of inflexibility. And so a lot of advisors, when looking at this, said, you know what, can't be bothered, too much paperwork. I don't like the setup costs. I don't like the annual fees to the province. So many.
And I would say it would be, when you say advisors, that's, accountants as well as wealth advisors, right?
Yeah. And the clients themselves,
clients
themselves were coming to that conclusion. It wasn't imposed by the financial advisor. But on December the 8th, 2020, the provincial government of Ontario amended the Pension Benefits Act and said if you are a connected person under the Income Tax Act, meaning that you own at least 10% of the shares of any class of your company, you're connected under federal tax rules, your pension plan, your registered pension plan does not need to be registered with the province anymore. You only need to register with the CRA.
Right.
So that means the mandatory contribution rules disappeared. The mandatory locking in rules, meaning you can't take the money out before retirement, disappeared. The registration with the province, with the paperwork, disappeared. The annual fee that you have to pay FSRA or FSCO disappeared. So all of that heavy bureaucracy is no longer relevant in Ontario since December the 8th, 2020. So that's number one.
That's not a little change. That's a huge.
The sea change.
Yeah.
So that's one thing. The other thing is the federal government, because remember I said there's two levels of government regulating these plans. The federal government has also been mucking around with the tax rules. And for example, in 2018, the federal government introduced the new tax on passive income. So people who used to keep the money tied up in their corporate non-registered investment account, if they got too much of that building up inside their corporation, are now penalized when it comes to their active business tax rate, right? They can lose their small business deduction. And on every dollar that the company earns of top line revenue, now they might be paying twice as much tax just because they're using their corporation as if it was a pension plan, because they have passive income building up inside of their non-registered investment account. So that militates in favor of getting that passive income out of the balance sheet to something that's not on the balance sheet, like the registered pension plan. Recently, last year or the year before, the government said, we're going to increase the inclusion rate on capital gains from 50% to 66.6%, which makes it even more, would have made it even more expensive to keep the money invested inside your corporation.
Yeah, that announcement came out in 2024, but then there was a rolling back and it has remained the same. But there's always a risk that change does come into effect at some point down the road.
Well, if you read the tea leaves, you know that our governments are strapped for cash. And you should, your listeners or your viewers, if they are young or younger, they may not know that the inclusion rate used to be 75%.
Right.
And that was not introduced by a liberal government. That was introduced by a conservative government. So it is possible that if governments are cash strapped, that they may look to the inclusion rate. They tried to do it in 2024. They got told that they might have a a revolt on their hand, so they peeled it back. But given how governments are so indebted around the world,
The
I
distinct possibility.
the
Yeah.
distinct possibility. I would bet money that this will be coming at some point in the future.
Well, I won't hold you to that bet, but I do see, and I've been tiptoeing here in the champion world of IPPs, which is why we're connected here, and I've invited you on. It's all great. Now we have a background. Great, that's what the program is. Those are the changes. But let's talk about some real life stories, because it's through stories that we can then really relate to what might be going on in our own world and see the possibilities. So I know when we chatted a few months ago, um, it was just one story after another. So I would invite you to pick one and let's start there and chat about it.
Sure. Well, let's start with my friend Jeff. I can't, obviously, for confidentiality reasons, I can't give you the
Mhm.
last name, but Jeff is a 73-year-old business owner, and he ran a very successful commercial real estate company for decades and decades.
Mhm.
In fact, his sons, a couple of his sons, have been on the payroll of his family business for about 20 years. And Jeff came to me and said, yeah, I signed up for an IPP with a competitor of yours years ago. And because I was investing in certain private asset classes, I've done extremely well. And now my IPP has over $8 million of assets in it. Now, at age 71, you have to start taking a pension out. You can't defer forever. Just like with a RIF, an RSP RIF, you have to start taking money out. The government
Mhm.
wants their pound of flesh.
Mhm.
So out of that 8 million, he was collecting a decent pension every year. And Jeff came to me and he was asking me some questions about investments and all that inside the pension plan, like the legal aspects, not what to invest in, but sort of how to structure it. And I said to him, hey, why are you the only member of your pension plan? And his answer was, what do you mean? It's an individual
Individual.
pension plan.
Yeah.
Why would there be anyone else but me in it?
Yeah.
I said, that's just a name.
Mhm.
That's just a name. You can have other employees of your family business part of your pension plan. He goes, oh, I didn't know that.
In particular,
His sons who are on the
right.
payroll,
Hmm.
who've been on the payroll for 20 years. So I said, in his next question was, JP, why would I add my sons to my pension plan? I said, Jeff, if you were to die tomorrow, given that you're a widower, you don't have a spouse, your $8 million commuted value, your pension fund assets, cannot roll over tax free to your spouse because you don't have a spouse. So we're going to have an income inclusion. Your 8 million will really become 4 million because 50% or more will be gone to the CRA. But if you follow my advice and you add your sons who've been on the payroll forever to your plan and you die tomorrow, the $8 million becomes pension surplus. Why is it surplus? Because there's no one to pay a pension to. The pension plan can't pay you a pension, Jeff, you're dead. Can't pay your spouse a survivor pension, she's not even alive. So all the money is surplus. But you've added your children as members, so they need that money for their own pension when they decide to retire. Therefore, every penny, the full 8 million, stays tax sheltered. So that in a 15-minute conversation, I saved his family a minimum of $4 million.
Right. And then if his children eventually bring their children into the business, so now you've just created a waterfall or cascading effect here. And then on top of that, the children, the next annuitants of the pension would be contributing to the pension plan, and that would all be growing
Well, they wouldn't.
continuously.
They actually technically wouldn't contribute because the plan would be in excess surplus.
Right. Okay.
So they
Yeah.
didn't even have to contribute to end up with a pension plan, which is nice.
Yeah.
But contrary to a family trust, which is a sort of a competitor, the family trust has a 21-year deemed disposition tax rule that plagues it.
Right.
This
This
is a
doesn't.
this is a pension trust. So there's no 21-year issue. So this could go on for decades, for centuries. If that family continues to add generations, that pool of money just gets larger and larger and larger. So that's
Yeah.
one example.
That's one example, and how many other examples are out there that either that whole opportunity got missed, but other examples where the program in and of itself is not being fully optimized.
Well, so to wrap up on Jeff, so when I revealed this to Jeff, he got
Mm-hmm.
teary-eyed.
Mm,
A grown man, 73 years old,
yeah.
tears in his eyes. It says, JP, I'm one heartbeat away from a heart attack. Why isn't that my advisor never told me this? I mean, I'm paying my advisor 1% on assets. So that's $80,000 a year fee that this advisor is collecting every year. Don't you think he could have mentioned this to me? What about my accountant
Mm-hmm.
who's supposed to help me save on taxes? Saving $4 million in taxes is a big deal. How come my accountant tell? What about my lawyer that I pay whatever $1,000 an hour? Smart guy with a big firm. Why didn't he come up with this? And I'm like, listen, I don't know. I mean, I guess you've never spoken to a pension lawyer before today.
Because it's a very specialized field, and it's one of those things that when you don't know, you don't know, and sometimes it does get dismissed because it's not well known, right?
It never gets brought up because there's
Yeah.
no real champions out there. You know,
Mhm.
you're one of the exception in the advisory world. There's a handful of people like you, Colleen, that actually care and talk about these pension plans. Most advisors couldn't be bothered. So
Well,
that's
we're working on it.
so that was one example.
Mhm.
Did you want me to throw you another example?
Yeah, let's go with another example because I think it's just so much easier to relate to examples than going through, a technical case study.
Yeah. So I had a client who was a lawyer in Toronto,
Hmm.
had his own law firm, and had set up a pension plan with us. And then, for whatever reason, one day traveled to Grand Cayman and loved it, and decided when he came back that that's it for Canada. He's
Oh
picked.
no, but okay.
Yeah, poor guy. So he decided to move his family to Grand Cayman and become a non-resident of Canada for tax purposes. And he had a lot of money in his legal professional corporation, holdcos, and
Hmm.
other personal assets. And of course, he discovered, even though he was a lawyer and he should have known, he discovered the departure tax,
Right.
the deemed disposition when you become a non-resident of Canada. And that applies to the shares that you own, right? And the value, because those shares were a penny when he incorporated, and now they're millions of dollars in them. So there's a massive tax hit.
Hmm.
And he called me in a panic saying, oh my God, what about my $2 million pension plan? I said, what do you mean? Don't you know? I mean, you're a lawyer, should know. Don't you know that every penny inside of your pension plan is considered an exempt asset and there's no departure tax on your pension money? So zero tax on leaving Canada, at least for what you have in your pension plan.
Hmm.
The rest, well, I can't help you with the rest because
Right.
so he was happy with that because that saved him about 500 grand right there.
Yeah. Now, there will be tax once that pension plan starts generating a future cash flow,
But not under the departure tax.
not under the departure. Just
Yeah,
wanting to clarify, like
yeah,
it's
yeah.
not, yeah.
So, well, actually, that's another thing. So then he goes, okay, great. So I save $500,000 in immediate tax on departure tax on the capital, the 2 million. But what about the monthly pension or annual pension that the pension plan is going to wire to my bank account in Grand Cayman? Well, how much tax am I exposed to now that I'm going to be a non-resident of Canada? And I said, well, the good news is that instead of paying 53% in Ontario, you're going to be paying 25% flat, because that's what the Income Tax Act says for a non-resident. Now, that's Grand Cayman doesn't have any tax treaties with Canada because it's tax haven.
Mm-hmm.
Had he moved to France, Portugal, Greece, Germany, I mean, there's about 100 countries around the world. Those tax treaties override the 25% rule, and they usually fix it at 15%, 1-5.
Mm-hmm.
So his company got a deduction at 26.5.
Mm-hmm.
The money grew with no tax. And when it finally comes out in the form of a pension, it's exposed to a 15% tax rate. If that's not a recipe to create money, to print money, I don't know what else is.
And the contributions going into, because we didn't cover this, I have covered it in the past, and there will be some other episodes here on the podcast that cover it, but probably in case somebody's listening today and they haven't heard those episodes, I think maybe it would be worthwhile to talk about that for a minute.
Yeah.
So the contributions that are going into the pension itself, let's talk about briefly the logistics of how that works.
Sort of the elevator pitch.
Sure. Let's call it the elevator pitch.
Yeah. So with an RSP, you get one annual contribution, 18% of last year's earned income up to RSP max, which is $32,490 this year. If you're doing a pension plan, you get 7 tax deductions. You get one for recognizing years of past service. If your company paid you a salary in previous years, we get a deduction for that. You have a higher than 18% annual contribution, which can go all the way to about 30% when you hit 64. You have an RSP double dip contribution in the first year. So not only are you putting more money in your pension plan, you can also put money in your RSP. You have what are called special payments, which are catch-up payments if the money invested at RBC DS is not earning 7.5%. You can get extra corporate deductions to catch up to keep the plan fully funded. You have investment management fees. So whatever RBC charges and investment management fees become extra deductions for the company. If you borrow money, the interest paid to RBC Bank on the line of credit is also a tax deduction for the company. And then you have a final deduction called the terminal funding contribution, which is if you decide to turn on the pension before age 65 and you didn't want to be penalized because of that, the company can dump all kinds of extra money into the pension plan to give it more assets so that it can afford to be more generous to you and pay you a higher early retirement pension that's fully indexed to the cost of living.
So these are all deductions available within the corporation.
Yeah.
So that you're, I like to use the word optimize versus, anything else, optimizing tax, because you're going to pay tax at some level. You want to pay only your fair share.
Well, the corporation won't pay any tax because it claims the deduction because it's an expense of doing business. You, as a plan member, will pay tax when you pull the money out, but the corporation won't pay tax.
Right. But the money going into the plan is a tax deduction to the corporation.
Correct.
Yes. Right. Reducing the overall taxes payable in the corporation.
Yeah. And a lot of people think that the only source of money to fund a pension plan is active business top line revenue coming in that's typically taxed at a lower rate, 12.2% or 26.5%, depending on how much money the corporation has in taxable income. But that's not the only place where this money can come from. It can also come from the passive investment income of the company. And this is my second or third case study that I wanted to bring to your attention. So we had clients with tons of non-registered corporate assets that were building up unrealized gains because they were capital properties, either shares, trade on the stock market, units of mutual funds, some real estate that had been acquired at X. And now if the company were to sell it, it'd be X plus Y. There'd be a massive capital gain.
Right.
So I said, why don't you sell some of that stuff in order to fund your pension plan? And then they said, no, JP. If I do that, my corporation is going to be facing passive corporate tax. And in Ontario, it's 50.17% because it's not active business. And I said, what are you talking about? You're not going to pay any tax. So I had to work out an example. I said, okay, the company bought shares for $100. Now they're worth $500. So you sell those shares. The company sells those shares. 500 minus 100 is $400 capital gain. The inclusion rate is only 50%. So the company is only going to be paying tax on $200. But the company is not paying that tax because it's going to take the $200 out of the $500 realized and contribute it to the pension plan. So that gives the company an offsetting deduction of $200. So the tax is zero, not 50.17%. So that's good news number one. Good news number two is that the other 50% of that capital gain is a CDA credit, a capital dividend account credit. So now my client can say, wow, I had 500 when my company sold that share. I put 200 in the plan, so I still have 300. I'm going to use 200 of the 300 and declare a capital dividend to myself.
Right.
So now they're collecting tax-free income.
Distribution out of the corp.
And the company paid zero tax. Well, isn't that pretty cool? I mean, it's like a TFSA.
Yeah.
You've created your own little corporate TFSA. You're collecting $200 or $200,000 with no personal tax. Your company paid no tax. And the other $200 you put in the pension plan now is growing free from future tax because it's in a sheltered account.
So these are all great scenarios. Now, in your opinion, what is the ideal structure? Who's the ideal target for one of these registered pension plans, which we call individual pension plans or personal pension plans?
Yeah. Well, there are a couple of targets. My favorite is the family business owner that has multiple generations. Because you can't beat that, my Jeff story.
Yeah. Powerful.
Well, it would take someone like you a lot of effort to generate $4 million of value for a client, right? It would take more than 15 minutes on the phone call, typically. But family businesses, no-brainer. The other no-brainer are what I call C-suite executives of large companies that are not shareholders, where they are paid very high levels of T4 income and usually salary plus large bonuses. These folks are getting the wool eaten off their back by the CRA because they're paying 53.5% on their compensation. They never see that money back. But if they came to you and said, hey, can you help me? We could set up a pension plan for them. In fact, we might even do a pension plan and a supplemental pension plan, a retirement compensation arrangement, an RCA, which is another story, maybe another podcast.
Yeah.
And use a lot of that compensation that they normally get and redirect it into those pension plans.
Now, you need the company to be on board with that.
You need it. But if you're a C-suite executive, if you're the CEO, you should have a little bit of pull with the board, right? If you're the CFO, if you're the COO, CLO, you should, in theory, be able to say to the board, listen, company, it's not going to cost you any extra. Whether you pay me $500,000 salary bonus or pay me, $400,000 and then put $100,000 in my pension plan, you're still getting a $500,000 deduction. You're no worse off from a tax perspective.
Right.
But I'm a lot better off because now instead of paying 53% tax, I'm paying zero tax because it's being sheltered and it's growing under your care, Colleen, so that when I do retire, I have something to retire on. Right now, if there's no pension in place, you pay the tax and you're on your own. So C-suite executives, huge market, totally untapped. Most people don't even know you can do this. And then the last one is what I call your incorporated professionals,
Right.
doctors, lawyers, pharmacists, accountants, you name it, that have very few legitimate tax deductions within their corporation.
Mm-hmm. And
So,
may also have hefty holding companies or hefty passive
yeah,
investment portfolios where
because
there's an opportunity.
they
Yeah.
didn't know about the pension solution, so they followed the classic advice of just plowing the money, the retained earnings, in an unregistered corporate investment account, and then building up unrealized gains, right? Thinking that they had created a pension plan for themselves.
Mm-hmm.
Those people, we can help them squeeze that passive stuff out of the balance sheet and dump it into these tax sheltered solutions and create all those CDA credits that we were just talking about.
Mm-hmm.
So,
Well,
yeah.
pensions can sound kind of boring, but when you dig into all the nuances, it's actually a pretty innovative way to build wealth and create a lower tax obligation.
Well, what's ironic about you calling them innovative is that the pension rules in the Income Tax Act date back to the very first Income Tax Act of 1917, whereas the RSP rules only came out in 1957
Hmm.
and the TFSA in the 2000s.
Right.
So the pension stuff is bedrock. It's been there forever. It's just that people uh, can't be bothered because this is too complicated.
Yeah, it seemed really rigid.
Yeah, and to be fair, until in Ontario until 2020, there was a lot of rigidity. We still felt that there was a compelling case to put them in place, but now there's no excuse.
Hmm.
All the excuses have fallen away.
Yeah.
And the only thing that prevents business owners from saving more on taxes is apathy and lack of knowledge in the industry.
Now it needs to be a healthy business with appropriate amount of cash flow. I mean, there aren't the obligations to make the payments, but would you say like that's inappropriate? You're
Yes,
you're wincing.
yes and no. Yes and no. I mean, like even imagine a marginal company that has very little income, but the business owner is in a risky industry, and they've got $2 million in an RSP at the Royal Bank or RBCDS. They would be a candidate as well, even though their annual company has very little money to contribute, because the $2 million RSP can be transferred tax-free inside the pension plan through the additional voluntary contribution account.
Right.
And now that it's becoming pension money, the creditor protection rules that applies to pension plans now protects that $2 million, whereas
Right.
RSPs, at least in Ontario, are not creditor protected unless they're with an insurance company.
Right. Right.
So,
So
so
you add that additional, that becomes the overall benefit in those cases. Yeah.
that's a creditor protection advantage, not a tax advantage.
Hmm.
There's another advantage that's nothing to do with creditor protection in this extreme case that we're talking about. So if you die with $2 million in your RSP and you don't have a spouse because you can't do a rollover to the spouse, maybe you're divorced, maybe you're single, maybe spouse dies in the same car accident. What happens in the Income Tax Act is that the full 2 million is included in your taxable income in your terminal tax return,
Hmm.
right? So your estate's going to be paying 53.5% tax on it. Okay, typically 2 million for sure. Well, marginal. So average might be 50% tax. But if you had the $2 million in your pension plan and you designated a whole bunch of beneficiaries, my kids, my grandkids, the University of Toronto, Saint Princess Margaret Hospital.
Carleton University, Ottawa U.
Perfect. Who's yours? Who's your Ottawa-centric ones?
Yeah, Royal Ottawa Foundation for Mental Health.
Perfect.
Okay.
Perfect. All your Ottawa-based beneficiaries.
Yeah, Ottawa Salus. Yeah,
So,
all
so,
those.
so what happens? Section 56 of the Income Tax Act specifies that taxation of monies from a pension plan occurs in the hands of the beneficiary. Well, the Ottawa Hospital and the Carleton University,
They
they're
don't have.
tax exempt.
Mm-hmm.
So that pension money doesn't get taxed at all. And if you split the rest with a whole bunch of people, they only pay tax on what they receive. So you have the potential for a significant pension income splitting or income splitting phenomenon.
Mm-hmm.
So if you were to tally up all the taxes paid with a pension plan versus the RSP, it could be huge difference.
Okay, so that is a new point that is a new point for me today.
Yep. So that's one example in this extreme situation where the business
Mm-hmm.
doesn't have a lot of revenues,
Mm-hmm.
right?
There's still this, I mean, that's a benefit to any pension that is set up, but in particular, if you're thinking about why would you do this under the scenario of maybe not being in a position where you're funding the pension plan on an ongoing basis, because the cash flow is just not quite the same as another. Yeah. Wow. Okay. Wow.
Well, if let me throw something else at you, still with this case.
Mhm.
Person decides to cross the border and decides to collect a pension from the pension plan. Remember what we talked about, the tax treaty, 15% flat?
Right.
If you do an RSP withdrawal, it's 25% tax because it's not ongoing, periodic, and regular.
Right.
It's lump sum. So you have to pay 25% tax to CRA because it's an RSP withdrawal. Whereas if it's a pension, because it's ongoing, periodic, 15% tax. That's a 40% reduction in your tax bill. And it has nothing to do with the corporation and its taxes. It's just a personal tax issue.
Mm-hmm.
Right? So
really, like each scenario needs to be looked at for its own merits of whether or not this is an option. And for an incorporated professional, someone sitting in a C-suite earning a significant income, and incorporated business owners, which are, the majority of clients we're dealing with, not the sole proprietor. It behooves us to have this as part of a due diligence in looking at the wealth plan. And not just once, but along the way. Perhaps it isn't the right thing. It's determined that it isn't the right thing today. But a few years from now, it might be the right thing. So it needs to be part of the ongoing conversation that we're having.
yeah, because things changed. Business owners may have children who become of age to join the pension plan, for example. When you met them, they were too young, so there was no point. You couldn't add the children to the payroll. But now they turn 14 and they're working in the summer. Well, they can collect a salary from the corporation. They won't pay any tax because the salary is so low that their personal tax credits will wipe away all taxes personally. But now that they're employed, they're allowed to join the family pension plan. So the intergenerational wealth transfer, the Jeff story, now becomes a reality for that. But it didn't work when we first met them because the kids were too young.
Mm-hmm.
So that's something that
they weren't working in the business, actively in the business.
They're too young. They're too young to work. So we couldn't add them at the time. But now that they can work, even if it's part-time, clerical stuff, you're an employee, so you're allowed to join the pension plan.
Well, this has been enlightening, and we probably will have to have an update, some news stories along the way, maybe on the retirement compensation arrangements, the RCAs as well. But listen, first of all, how would a listener find you? I mean, obviously they can come talk to me. We should chat about it, and I would be in all likelihood be bringing JP into the conversation. But if somebody wants to reach out to you directly, how would they find you?
Well, they can just Google Integris Pension Management, and we're all over the internet now. And then talk to some of our salespeople, or sometimes you can book time with me. It's complimentary. And look at each case. Like you said, each case has to be looked at based on its own facts. And while it's theoretically possible that a pension plan makes no sense, to be honest, in 14 years of running this business, I could count on two hands situations where it didn't make sense. It's extreme, and we run tens of thousands of cases. So it's extremely rare that there isn't some benefit that's meaningful enough to go ahead. It's just that because people don't know,
Yeah.
they just it's not even part of the set of solutions.
So your fun, frank advice would be?
It's to spend a little bit of time to find out if a pension plan makes sense. There's no cost to it, and like I said, in 99% of the time or more, it's a no-brainer. It's just that people don't know.
Mm-hmm.
You don't know what you don't know, and that's the problem, right?
That's great. Well, thank you so much for being here today, JP. I learned something new that will be now part of my toolkit in conversation, and I look forward to chatting again soon.
Thanks for having me on your podcast.
Powerful reminder that strategy can build lasting wealth. And just because you don't know something now doesn't mean that you shouldn't learn about it. JP Laporte shared some really interesting scenarios and stories that show us that pension plans aren't just for government employees and big corporations. They could be real game changers for incorporated entrepreneurs who want to have a strong exit and build their cash rich exit. Of course, he is a champion and he's very passionate about pension plans. And so, just a reminder, his opinions are his opinions, and the facts are the facts. So take that for what it's worth. And hey, Self-Made Nation, if you're building your wealth through your business, inside your business, and you have not explored tools like an individual pension plan, now is the time. Connect with me, Colleen O'Connell-Campbell, on LinkedIn. Let's schedule your one-on-one wealth gap analysis. You can also email me, colleen.campbell@rbc.com. And if this episode helped you think differently about your wealth strategy, leave us a 5-star rating. It helps. It helps more founders find the show and build their path to a cash-rich exit. Thank you for listening. I'm looking forward to welcoming you back again soon. It's me, Colleen O'Connell-Campbell, Wealth Advisor at RBC Dominion Securities. TTFN. Ta-ta for now.